The year was 2019, a time when the world was on the brink of a digital revolution. The cryptocurrency market was abuzz with innovation and excitement as new technologies and platforms emerged almost daily. A new player emerged on the scene, FTX, led by the enigmatic and ambitious Sam Bankman Fried, who quickly became a prominent figure in the industry. FTX quickly rose to prominence, capturing the attention of traders and investors alike. It became a major cryptocurrency exchange known for its user-friendly interface and advanced trading features. Millions of users flocked to its platform, eager to take advantage of its innovative offerings. They were drawn to its promise of low fees, cutting-edge products, and a seamless trading experience. FTX quickly became a symbol of crypto's growing legitimacy and mainstream acceptance. It had secured billions in funding from eager investors who believed in its vision. It had partnered with major financial institutions, further solidifying its position in the market. The future seemed bright, filled with endless possibilities and opportunities. FTX's success was closely intertwined with Alameda Research, another venture by Bankman Fried. Alameda was a trading firm also founded by Bankman Fried, known for its aggressive strategies. Alameda made aggressive bets in the crypto market, often taking high risks for high rewards. Its profits bolstered FTX's balance sheet, providing a strong financial foundation. The close relationship between the two entities seemed to be a winning formula, driving mutual success. However, this relationship would later come under intense scrutiny, raising questions and concerns. It would play a pivotal role in FTX's downfall, as investigations revealed deeper issues. The seeds of disaster were sown even as FTX celebrated its success, hinting at the troubles that lay ahead. Behind FTX's meteoric rise, trouble was brewing. Alameda Research, FTX's sister company, was taking on significant risk. It was engaged in highly leveraged trades. These trades were based on volatile crypto assets. While Alameda's bets had initially paid off, the market was becoming increasingly unpredictable. Losses began to mount. These losses did not stay confined to Alameda. The close relationship between Alameda and FTX meant that FTX's own funds were intertwined with Alameda's risky ventures. As Alameda began to falter, it pulled FTX down with it. The cracks in the facade were starting to show. Whispers of Alameda's troubles began to circulate within the crypto community. These whispers would soon turn into a roar, shaking the foundations of FTX. In early November 2022, the crypto world was rocked by a bombshell revelation that would send ripples through the entire financial ecosystem. A leaked balance sheet revealed the extent of Alameda Research's financial woes, exposing vulnerabilities that had been hidden from the public eye. The balance sheet showed that a significant portion of Alameda's assets were tied to FTT, FTX's own cryptocurrency token, raising eyebrows across the industry. FTT was not just any token, it was the backbone of FTX's financial structure, making the revelation even more alarming. This raised serious concerns about the stability of both entities, as the interdependence between Alameda and FTX became glaringly obvious. The leaked balance sheet sent shockwaves through the crypto market, causing panic and uncertainty among investors and stakeholders. It suggested that FTX, despite its outward success and polished image, was built on a foundation of its own highly volatile token, FTT. This revelation shattered the illusion of stability that FTX had carefully cultivated over the years, leaving many to question its true financial health. The market reacted swiftly and brutally, with investors scrambling to reassess their positions. FTT's price began to plummet almost immediately, reflecting the loss of confidence in the token and the platform. Investors fearing the worst started to pull their funds from FTX, leading to a liquidity crisis that further exacerbated the situation. As the leaked balance sheet circulated, panic began to grip the cryptocurrency market. Investors fearing a repeat of previous crypto collapses rushed to withdraw their funds from FTX. The situation escalated rapidly when Binance, the world's largest cryptocurrency exchange and a one-time investor in FTX, announced it would liquidate its holdings of FTT. Binance's announcement was a devastating blow to FTX. It signaled a lack of confidence in FTX's ability to weather the storm. The announcement triggered a full-blown run on FTX. Users desperately tried to withdraw their funds. However, FTX was unable to meet the overwhelming demand for withdrawals, The exchange faced a liquidity crisis. The once mighty FTX was on the brink of collapse. Section 5. The run on FTX, a liquidity crisis unfolds. The crypto world was about to witness an unprecedented event. The news of Binance's impending FTT liquidation spread like wildfire, sending shockwaves through the entire cryptocurrency community. Panic gripped the crypto market, with traders and investors scrambling to make sense of the rapidly unfolding situation. FTX users, fearing the worst, rushed to withdraw their funds, hoping to salvage their investments before it was too late. The exchange was hit with a deluge of withdrawal requests, overwhelming its systems and causing significant delays. This overwhelming demand exposed a critical flaw in FTX's operations. It didn't have enough liquid assets to cover the withdrawals, leading to a severe liquidity crunch. FTX tried to stem the tide by seeking emergency funding and negotiating with potential investors. It paused withdrawals, hoping to buy time and stabilize the situation, but the damage was already done. However, this only fueled the panic further, as users took to social media to voice their concerns and frustrations. The exchange that had once boasted about its robust infrastructure was now crippled by a lack of liquidity. The situation was dire. FTX was hemorrhaging money at an alarming rate. Its future hung precariously in the balance, with the entire crypto community watching closely, wondering if FTX could survive this crisis. Section 6. The failed rescue and the fall of FTX. As FTX teetered on the brink, a glimmer of hope emerged. Binance, the very entity that had triggered the run on FTX, entered into discussions for a potential acquisition. The crypto world held its breath. Could Binance swoop in and save the day? The hope was short-lived. After reviewing FTX's financials, Binance backed out of the deal. The news sent shockwaves through the industry. FTX, once a symbol of crypto's bright future, was now staring into the abyss. With no potential buyer and facing mounting withdrawals, FTX had no choice but to file for bankruptcy. The collapse was swift and brutal. It sent the cryptocurrency market into a tailspin. Section 7. The aftermath, legal battles and market fallout. The collapse of FTX sent shockwaves throughout the financial world. The cryptocurrency market reeled as the value of Bitcoin and other cryptocurrencies plummeted. The fallout was immediate and severe. Lawsuits piled up as investors, users, and partners sought to recoup their losses. Regulators around the world, who had long been wary of the largely unregulated cryptocurrency industry, sprang into action. Investigations were launched in multiple jurisdictions. The U.S. Department of Justice, the Securities and Exchange Commission, and numerous congressional committees all opened probes into FTX's collapse. The once lauded golden boy of crypto, Sam Bankman Fried, faced intense scrutiny and multiple criminal charges. Section 8. Picking up the pieces. Rebuilding trust and regulation. The FTX collapse exposed the fragility of the cryptocurrency market. It highlighted the urgent need for greater transparency, accountability, and regulation. In the wake of the disaster, calls for stricter oversight of the industry intensified. Governments worldwide are now under pressure to implement comprehensive regulatory frameworks for cryptocurrencies. These frameworks aim to protect investors, prevent market manipulation, and mitigate systemic risks. The industry is also grappling with the need for self-regulation. Rebuilding trust is paramount. The task is daunting, but essential for the long-term health of the cryptocurrency ecosystem. Section 9. Lessons learned, the perils of unchecked power. The FTX saga is a cautionary tale about the perils of unchecked power and the dangers of conflicts of interest. FTX's downfall was not merely a technological failure or a market downturn, it was a human failure. The close ties between FTX and Alameda, the lack of independent oversight, and the concentration of power in the hands of a few individuals created a breeding ground for recklessness and, ultimately, disaster. The collapse serves as a stark reminder that even in the decentralized world of cryptocurrency, human greed and fallibility remain very real threats. Section 10. The future of crypto, a turning point. The FTX collapse marked a turning point for the cryptocurrency industry. It shattered the illusion that crypto was immune to the risks and failures that plagued traditional finance. The event forced a reckoning. It prompted a reassessment of the industry's fundamental values and practices. The future of cryptocurrency remains uncertain. However, one thing is clear: the industry cannot afford to repeat the mistakes of the past. To regain trust and fulfill its potential, the crypto world must embrace transparency, accountability, and responsible innovation. Section 11. Conclusion: a stark reminder. The FTX collapse stands as one of the most significant events in the history of cryptocurrency. It is a stark reminder of the risks inherent in this emerging asset class. The event underscored the need for greater regulation, transparency, and investor education in the crypto space. The collapse left countless investors nursing losses, eroded trust in the industry, and triggered a wave of regulatory scrutiny. While the full impact of FTX's downfall is still unfolding, it has undoubtedly left an indelible mark on the cryptocurrency landscape. The road to recovery will be long and arduous. However, the lessons learned from this debacle could ultimately lead to a more resilient and trustworthy crypto ecosystem.